Hello and welcome to another edition of Lodging on Demand. In this episode, Lodging Editor-in-Chief Dennis Nessler discusses current transaction activity within the lodging landscape and the economic factors that are impacting deals. Today's guests are Dan Lesser, co-founder, president, and CEO of LW Hospitality Advisors, as well as Kevin Davis, America's CEO with JLL Hotels and Hospitality. The finance veterans also offer their projections on what they expect to drive deal activity heading into the second half of 2024 and into 2025.
Hi, this is Dennis Nessler, Editor-in-Chief of Lodging Magazine. I'm here this morning with Kevin Davis, America's CEO, JLL Hotels and Hospitality, and Dan Lesser, co-founder, president, and CEO of LW Hospitality Advisors. Welcome, gentlemen. How are you guys doing today?
Great. Happy Friday.
Thanks for inviting us.
That's
Yeah,
my
absolutely.
pleasure. My pleasure. Well, let's dive right into it, guys. We want to talk a little bit about transactions, and obviously, in the hospitality space, transactions have been pretty slow the last, I'd say, 24 to 36 months. To what do you attribute that? And then we'll talk a little bit about maybe some things going forward. Dan, you want to start?
Sure. Listen, clearly the rise in interest rates has had a dramatic effect on the pullback in transactions, and there's a pretty wide delta in terms of bid-ask spreads between what any willing seller is expecting for proceeds versus what a buyer is willing to pay. And that clearly has been the driver. The hotel industry is doing fundamentally extremely well. The fundamental economics look great. And the last thing I'd like to say too is that, interest rates are elevated compared to where they were 18, 24 months ago. But when you look back on a long-term basis, call it 50 years, 40 years, interest rates are really not that high. So everything's relative in life. And that's my summation.
Sure. Kevin, your thoughts?
I would just add, I agree with every point that Dan made. I would just really focus on the rate point and the fact that rates are higher. It's not just that they're higher. Rates were abnormally low for 14 years post GFC during the period of quantitative easing, and the market got hooked on low rates, and assets were acquired based on the assumption and the expectation, frankly, that rates would stay relatively low. And so we were in a market where the cost of debt was anywhere from 3 to 5%. You fast forward, we've had 500 plus basis points of increase in rates since March of 2022. The cost of debt is now 8, 9, 10%, and asset values are readjusting and recalibrating as a result. So you're talking about going from a long period where rates were low and asset values were reflective of that to what now appears to be a medium-term situation where rates will be materially higher. And frankly, the expectation that rates aren't going to go back to where they were before. Not quite clear where they're going to settle or when they're going to settle, but certainly not where they were previously. And so the market is adjusting to that. So that's the more detailed dynamic that we're seeing take place in the market today, which is obviously slow transactions.
Mm-hmm. Do you guys see rates being cut in the next several months?
So my personal view is that we're probably looking at maybe one rate cut before this year is out. It's certainly also possible that we don't see any. My sense of when rates actually come down, I think we're looking at a, frankly, sort of 24-month period between where we are today versus where we're going to ultimately settle. I do think inflation is fairly sticky. So unless we see a material degradation in the economy, I think it's going to be a fairly deliberate path from 5.25 Fed funds rate back to 3% or so.
If I could just weigh in as well, listen, the 14 years that Kevin referred to was clearly an anomaly. For all intents and purposes, borrowing money was free, and that's not the way the system works. I like your question about when we think rates going to come down? I'm asked that question several times every single day. My standard response is that I'm not an economist, so I have no idea. With that being said, even the economists have got it all wrong, right? The economists were calling a recession. It's the longest predicted recession that I ever recall. That never happened, right? And the same thing with rate cuts. So the reality is nobody really knows, right? We can only take sort of educated guesses as to when rates are going to come down. I would concur with Kevin's thesis, and in particular that we're not getting back to where we were.
Mm-hmm.
Yeah, and look, to Dan's point about nobody really knows, you asked the initial question was, why is transaction volume slowed? It also is tied into the fact that there's just great uncertainty about what the rate environment will be over the next 4 months, 6 months, 12 months, 24 months. So if you're looking at a 3 to 5 year hold, in order to make an investment, particularly at prices where sellers are willing to sell, you have to have a fairly firm view that rates will probably come in at least 250 basis points. And not everybody's there yet in terms of having that belief. So the uncertainty around the future of rates is also arresting transaction volume.
And just to amplify a moment about uncertainty, right? We're in a presidential election year, and there's a lot of uncertainty as to what direction the country is going in. I don't want to delve into politics, but clearly there's a lot of sensitivity around who ultimately is going to be leading the country. And I think once that is behind us, irrespective of who it is, it's going to bake in a level of certainty. It has to.
Sure.
Yeah.
No question.
I agree.
Kevin, there's a lot of maturities coming due. We've been hearing this for years, about kind of this flood of maturities that were going to come due. Is this the year that actually happens, and what's the impact overall on the market?
Look, I remember first having this discussion in 2008, on the backs of $230 billion of CMBS that was issued in 2007. And here we are, 08, 09, in the midst of the GFC. And everybody talked about the wall of maturity in 12 and 13 and 14, which ultimately never materialized. Look, I think the net effect is likely the same here. Look, there's a lot of debt coming due, but we're also in a situation where hotels are generally performing across the country. It has been one of the better performing asset classes. And as a result, we've seen lenders be much more permissive in terms of working with borrowers to extend, cash new loans. It's only the most challenged and troubled assets where you typically see lenders forcing a repayment or sale. And so you're certainly starting to see that happen, but I don't expect that you're going to see a landslide of non-performing loans or large portfolios in the hotel space that will come up. So that's a long-winded way of saying I think there will be an orderly refinancing, loan sale, asset sale process that takes place. Those maturities will certainly spur some investment sale activity, and we're starting to see that happen. But again, the markets are incredibly efficient, and I think the process that we will go through will be an orderly process. I don't expect a significant wave of distress triggered by loan maturities that can't get refinanced.
I agree with everything Kevin just articulated, but because of the phenomenon he just discussed, there will be a fair amount of transaction activity, not necessarily sales, but transactions. And to Kevin's point, hotels it's really remarkable. I've been doing what I do for quite some time, and I don't ever recall a period of time where hotels were considered a darling asset class compared to office buildings. But that's where we are today. And the last point I'd like to make too is that there's an enormous amount of capital out there, both debt and equity. There was a period of time just a couple of months ago, for a period of time before then, where lots of folks were saying, oh, debt's really tough to come by. There's no debt. That's ridiculous. There's been debt throughout this whole, past 18, 24 months. Now, albeit now you have to pay a return on that debt, right?
Right.
But the debt's available. There's no question about it. And look at the CMBS market today. I mean, there's tons of CMBS available for hospitality.
Dan, are there any markets in particular that have seen a little more transaction activity that have, for whatever reason, it's been easier to get deals done? Any particular U.S. markets?
I think New York is an incredible market to take a look at, right? 4 years ago today, right, we were in the depths of COVID. The world was coming to an end. New York was written off as being done, finished, never coming back. And look where we are today. You walk on the streets of Manhattan, and it's just full of business folks, tourism, et cetera, et cetera. And we've seen more transaction activity occurring in New York. I like to look at MCR's acquisition, what was it, April 22 of the Sheraton Times Square, as being, really seeing sort of very forward thinking, right? They bought that for $250,000 per room. Now, gross proceeds, because of the size of the hotel, it was $370 some odd million, which is a lot of money, right? But $250,000 a room, you could not replicate that hotel for multiples of that amount. And so I think there was smart money making bets back then, and there's smart money making bets in New York right now and eager to get into the market, irrespective of all the operational challenges, and there are many of them in New York and other markets. And the last thing I throw out there is I like San Francisco. I like San Francisco on a long-term basis. If investors are ready, willing, and able, if need be, to hold on for 10 years, if you buy at market value today in San Francisco and are ready, willing, and able to hold for 10 years, I don't know how you can lose. That does not mean that if a capital event opportunity bubbles up in year 2, 3, 4, 5, where you can bake in some significant gains, that you won't take advantage of that, that you wouldn't do it, right? But San Francisco is getting a really bad rap these days. It's a beautiful city. It's a gateway to Asia. It has a history of dramatic highs and dramatic lows. Unless somebody believes it's literally going to fall into the Pacific Ocean, I think that's the market to invest in. I will tell you, I get a lot of pushback on that.
Yeah, look, Dan, I agree with you 100%. I think the challenge with that thesis, which I agree with, and I don't know if it's 10 years, I don't know if it's 6, 7, 10, whatever the number is. The challenge is private equity, which is generally the largest buyer, most active investor in our space, typically doesn't have that long-term horizon. So as a result, the assets have to get cheaper for it to make sense to private equity. So I think the buyers that you're saying, look, you certainly have seen some private equity go in, but I think the group that's kicking the tires the most in San Francisco right now tends to be high net worth money that does have a longer term horizon. But the preponderance of private equity as a buyer is part of the reason that transaction volume is lagging there, just because of the uncertainty around the time frame, and even just their inability to hold something for 10 years.
Unfortunately, we're almost out of time, guys. I just want one last question, if I can just get some final thoughts, maybe your overall outlook on transactions going forward, whether it's the back half of 24, even into 25. As Dan mentioned, the presidential election coming up, a lot of things to consider, but maybe just a minute or less, kind of your overall outlook. Dan, you want to go?
Sure. My reaction to that is I have seen this movie several times before. Transaction activity will become robust in the very near future. I don't think there's too much doubt about it. It has to. There's a little bit of a logjam now. Again, the whole bid-ask spread. And at some point, there's going to be significant price discovery in the market. And I think you're going to have a fair amount of capitulation as well, where sellers are going to realize, you know what, it is what it is, and do I want to keep feeding the beast or just move on?
Right. Kevin.
Yeah, I agree. And I may not, I'm not going to give you the broker answer. Maybe not. But look, I think over the balance of this year, look, we are starting to see the bid ask come together. I think over the balance of the year, maybe things will pick up a little bit. There are a couple of large trades that are in the works now that will get announced, so that'll be a boon to the market. But look, I think it'll be a bit more of the same, maybe at a slightly elevated pace. However, I do think post-election, and then also the turning of the calendar into 2025, the psychology around that, for all the reasons that Dan talked about, with some people just won't have the ability to hold any longer, either for capital reasons, debt maturities. I think you're actually going to see a pretty material pickup in 2025. But I think the impetus will be post-election, turning into the calendar with the conclusion being we just have to go.
Yeah, hope so. Gentlemen, thanks for your time this morning. I appreciate it, and all the best in the future.
Great.
Thank you.
Thank you. Appreciate it.
Thank you for listening to Lodging on Demand. If you would like more content like this, please subscribe to Lodging Magazine on YouTube. You can also subscribe to Lodging on Demand wherever you get your podcasts. For news and updates, follow at Lodging Magazine on LinkedIn, Facebook, Instagram, and X. Or visit us at lodgingmagazine.com.